Good afternoon, everyone. Thank you so much for joining us today. My name is Maria Asher, and I'm co-portfolio manager on Westwood Select Equity and Dividend Select Equity strategies. Today, we wanted to take this opportunity to talk about what's going on in Russia and Ukraine and its implications on global and US economy. For that, we have Adrian Helford joining us on the call. Adrian is the Director of Multi-Asset Portfolios and our CIO here at Westwood. Hi, Adrian. How are you doing?
Very well. Thank you for having me.
So let's get started. Adrian, I think the first question that is on top of our clients' minds is what's going on? The markets have been so volatile since the start of the year. So can you please recap for us what's happening and why it's happening?
Sure. It has been an extraordinary year for investors, for fixed income markets, and extraordinary in context of certainly just the past 13 years, and in some cases, in context of multiple decades. What is happening is just start very simplistically. The markets are swooning because the potential for a rate hiking cycle. Now, let's think about what that means and how that impacts markets. When base interest rates rise, that's what the Fed controls for the economy. The Federal Reserve is aiming to pull money back from risky activity, from investment activity. They are aiming to potentially take excess liquidity or money sloshing around in the system to reduce inflation. More money running around is more supply chasing the same amount of goods. They aim to reduce that and put it back into savings accounts. This is a very simple model that they would call the portfolio balance channel. So the aim is to reduce now inflation in this manner, and at bad times as well, reduce over exuberance, or what old Fed governors have called animal spirits. Uh, the problems with this are it's still a blunt instrument. It's a very blunt instrument at times when inflation is caused more by supply chain problems than it is by excess liquidity. That is an issue, but right now this is supply chain. We'll talk more about that in the future. Of course, the other thing that is happening right now is geopolitical concerns with Russia, Ukraine, one of the contexts for this call. I think that's a lower concern, and it leaves just a lot of people wondering what the impacts are. Myself, it's uncertain on a lot of the impacts. Uncertainty means higher risk premia. It means lower market valuations. Some things we do know are it impacts the supply chain. 30% of wheat and barley comes out of Ukraine and Russia, the breadbasket of the world as it's known. That leads to higher food prices. That leads to higher input prices for alternative goods that are made from those. Of course, energy is a well-known dialogue, not just oil, but gas prices. And gas prices going higher is a tax on consumers. It's a tax especially on middle and lower income consumers that rely on their car to getting to their job, and it's a meaningful portion of their budget. On average, it's about 12% of consumers' budgets. That's an impact, and that could lead to lower consumption in the future, less purchasing of goods for your kids or discretionary items that you might want otherwise because it comes out of the bottom line. So highly simplified, I think it's good to just have a framework for how we're thinking about things. Interest rates are rising. Bond prices are down. They are down in an extraordinary manner. We saw the worst March on government bond prices that we've seen since 1994. These are instruments which are, you're going to get your money back. The US government is going to repay. But a 3% US Treasury, where you earn 3% yield on that, is more attractive than a 2% US Treasury, where it was at the beginning of the year. For that reason, the price of that 2% Treasury drops dramatically. That's the impact that we've seen. So interest rates are rising. Your bond funds, if you own bond funds, those are dropping in price. It doesn't necessarily mean you're going to have less return of your principal. It just means on a mark-to-market basis today, prices are down. Equity prices are priced on generally future earnings capability and cash flows, which means economic growth, which means consumption. Are consumers going out and buying those discretionary goods, leading to better earnings profiles? That is impacted by exactly what I just said. The Fed is pulling the punch bowl from the party. Is the party going to continue? That's a question we have. I'm painting a highly simplistic model because there are other things happening with high savings rates. But generally, this is an impact. Maybe the last thing is there's a big there's a big difference right now between the Nasdaq and the S&P 500 or tech earnings and energy earnings right now. One of the impacts of that's a primary impact again is interest rates are rising, and when interest rates rise, as Wimpy told Popeye, a burger today is worth more than a burger tomorrow, especially when inflation is in the mix. These are tech companies that are predicated on long-term earning streams, on realizing cash flows on cars in Blade Runner 2054 when Tesla's on the side of all the cars there. That's different profile than energy companies that are extracting energy from the ground today and realizing cash flows on it today. Those longer term cash profiles become less attractive, even if they're still expected when interest rates rise, and that impacts tech valuations, and that's a large portion of the Nasdaq. So just to paint a simplistic model for what investors are seeing, I think it's helpful to think about it in that framework.
Thank you so much, Adrian. This is super helpful. And I think, can you think of a paradigm or a historical market paradigm which is similar to what we are seeing right now?
Sure, there's several, and there are always idiosyncrasies in markets. Now, one we're looking at lately is 1994. In 1994, we had the Fed that came out, and this is Fed Chairman Greenspan that came out at that time and gave a very hawkish sentiment. He was controlling for inflation and at that time animal spirits. Um, and it was an unexpected hike. They were a less communicative Fed than we have today. They didn't do the forward communication and other elements, though it was unexpected. And I remember when this happened, of an unexpected hike into the markets led to a downtrend at the beginning of the year. We had a broad sell-off in equity markets at the beginning of the year, which then led to, we're looking at this paradigm, the Fed taking a little bit of a pause as they reevaluated whether their impacts were good on inflation, and then of course whether they'd gone too far, if they were going to hurt the economy. And then at the end of the year, they kept a hawkish environment on. So we had a very difficult 1994. Things stabilized in the end, but as far as the Fed moving forward, 1994 is a good paradigm. And I would say just broadly, when we look at Fed hiking cycles, not always, but generally precede a recession. Does that mean we're going into a recession now? It doesn't, but it certainly raises our antenna in a big way for how much the Fed is going to constrain economic activity. We'll be watching next week when the Fed comes out for what signals they give us, what Fed Chairman Powell says as far as how he's going to try and control for inflation while trying not to break the back of the economy. So it raises our antenna. It doesn't mean that, but when we look to history, there is a concern.
Okay, that makes a lot of sense. So let's take a step back and think about January 1st. When the year started, we had wrapped up 3 consecutive years of 20% plus returns on the S&P 500 index. Market was pricing in 3 rate hikes. Then the inflation continued to run higher. Rate hikes expectations as of yesterday are 10 rate hikes for this year, and the war in Russia and Ukraine. So how has our outlook changed from where we were on January 1st versus where we are today?
Sure, good question. The war in Ukraine was unexpected, even though they were building troops at the border and we saw the geopolitical risk environment as a broad market. The actual invasion and the impacts that's had on supply chain and inflation, the ability for companies to get goods and labor, the uncertainty attached to risk premiums, all that has changed certainly since January 1st. When we did our annual outlook, actually, and at that annual outlook, I remember one of the investors saying, "My gosh, that's the most negative I have heard you speak, and most negative outlook I've seen." That was even in context of us having a single digits upside outlook for the S&P 500, because I think investors are so tested on the last 13 years, the average and the median return on the S&P 500 has been around 16%. And we reminded investors at that time that that is very unlikely to persist. Investors should reset to new standards, to think that 16% is not the new normal. It is, we're going to see some restrained growth. And at that time, we talked about a Fed that is going into a hiking cycle. For all of us market participants, they've communicated more than we expected. And they've done that because inflation has run more than they've expected. So, rightly so. At the tail end of last year, the Federal Reserve, Chairman Powell, was giving the inflation a transitory name and saying, basically, don't worry about it. This is supply chain issues. We're going to see that resolve. Companies are building up inventories, and when they stop building up inventories, buying more goods, they're going to be selling those inventories, and that's deflationary. So we're not going to break the back of the economy because we're fearing longer term inflation. Of course, he's since, as much as he can admitted that's a mistake. And so we are seeing higher interest rates, and we've gone from now the expectation. The market actually, I can use mathematics to derive what the market expectations are for how many hikes we expect this year. The market now expects 10 hikes this year. That's a lot. That is, hiking where usually when we talk about each quarterly meeting. If they hike, it's 25 basis points. That would be 1% over the course of the year. When we talk about 10 hikes, that's 250 basis points of hikes over the course of the year. Those hikes, as I say, that's pulling the punch bowl. So we are doing more than pulling the punch bowl. We're taking the food away as well. That's that's going to make the party difficult to continue when they do that. We'll see more next week, and we'll see communication from them on how they plan to differentiate between control of inflation and the economy. But certainly, it has led to a little bit more concern that, as I say, that there's this lack of exuberance may be justified.
Very helpful. So let's talk about it a little more. Fed is, at the end of the day, Fed is data dependent. It's not like they are not listening to all of the things that are happening in the markets or what's going on in the US economy. So right now, the expectations are for, as you said, 10 rate hikes. But if the economy continues to slow down, wouldn't Fed pivot? Wouldn't they change according to, because I know we understand that their goal is to control inflation, but are they really going to do it at the expense of having a much larger negative impact on the economy?
This gets down to where, if I were a Fed governor, and I'm not a Fed governor, but if I were a Fed governor, how might I communicate these things? We think about this as prognosticators here. They are worried about the deleterious effects of inflation for sure. They're worried about the political aspect of inflation and eroding consumers' purchasing power. That's what inflation does. It raises your price of milk and eggs and fixing your car and labor and everything else, which are crucial pieces of your income statement on the expense side, while they're worried that growth and wages may not go up at the same rate. They have to control for that, and they may have to do so even in context of hurting the economy. It's a blunt instrument though, and they're trying to control inflation with, this is what concerns me, with rate hikes that generally rein in liquidity. Liquidity is an issue, but it's not the issue. The issue is the supply chain problems, the inability for us to have the same supply of oil to meet the same demand, the inability of us to have the same supply of wheat and barley and chips and other things. COVID started that. Ukraine and Russia has exacerbated that. The Fed, I think, if I were a Fed governor, might do well to communicate something akin to, we could continue to rise rates and try and constrain inflation. Yet, as we see inflation come down, because we think it likely will come down as demand comes off some and inventories start to be sold, so they don't have to buy more inventories, the Fed could say, as inflation comes down, then we might pro-cyclically cut rates. We might, as the economy is still doing okay, we might adhere to a new normal in rates and set a lower base. The markets would like that a lot. They would see that less of a pulling of a punch bowl for exuberance and animal spirits and more geared towards just targeting inflation only. So that's something I think that would be helpful to think about. If there are ways to communicate, it's still a blunt instrument. Your question is a good one. It is concerning right now. What we see is a Fed that is more prioritizing inflation than they certainly told us that they would in the past when they said they would let it run hot. That's because it's run much hotter than they expected.
Okay, so let's dig deeper into inflation. As you said, Fed has thought of it as a transitory inflation, and a lot of us had, right? Last we thought that was most of it was driven by supply chain issues, and as the supply chain issues ease up, we will see year-over-year numbers improve on inflation. But now that we are seeing a war in Russia and Ukraine, which, as you mentioned, supplies 30% of global wheat and barley, and we are also, at the same time, there are lockdowns in China. So do you really see supply chain issues easing up near term, and as a result, inflation easing up near term?
Supply chain issues will take longer
Mhm.
to go through the economy. I think the war in Ukraine and Russia, or at least the hostilities and problems there, will take longer than many expect. And almost thus, although we still have COVID and other things, supply chain issues will take longer to go through the economy. One thing companies have done is they've built up inventories to a dramatically higher account. So companies are saying they want to make sure they can meet consumer demand of the future, and by nature, understanding that they're having a hard time getting their imports, they are going ahead. They have gone ahead and built up inventories to a large level. What does that mean? That means that as we see um, as we see companies start to say, okay, well, our inventories that are a good level, they can start to sell that down. That's deflationary or disinflationary, and it is because they're purchasing less. It's always in a supply demand context here. They're purchasing less because they're having to build up inventories less. We just saw that actually because we just saw a print yesterday
Mhm.
that was on GDP growth, and the economy contracted for the first quarter by 1.4%, an expectation it was going to expand by a 1%. So this was a miss. Now, let's think about what happened there. Funny, the markets went up, and we might question, well, why did the markets go up as well? This is where it pays to look into the underlying effects of the data. The market went up partially because it expected the Fed to respond and say, oh my gosh, we don't want to break the back of the economy. We may actually have to slow what we're doing. And number two, there was a read through to say, well, actually, once we get the underlying data, there was a big jump in imports and a drop in exports. One thing that has been driving the GDP growth, we saw extraordinary GDP growth just after COVID crisis. And one reason for that was companies building up inventories, as I'm talking about. They're pulling forward their capital expenditure, their inventory build. Uh, they're still purchasing, but at a lower rate. That was over 4% detraction from GDP growth. So if you dig into the underlying data, you also say, well, government spending shrank because we didn't have the stimulus that we had last year. So as that comes off, that optically looks like we shrank, but we didn't. We just lost some of the government stimulus that we had. But at the same time, we had better final purchasing. And so you can look out of this and you can see consumer demand and final purchasing. Final purchasing actually went up at about 3.6%. So that was reasonably strong. So what we're seeing are some dynamics here that still keep us what we think is going to be above trend growth. Trend for the GDP right now is around 2%, not high. We're seeing that come down substantially, and we'll be very mindful and watchful of that. But we do still see some consumer purchasing. There's a change in inventories. Some of that stuff could be, it's back to the inflation problem and the inflation question. Drawdown in inventories could be deflationary. As we see lower demand because the party may be over, then that's deflationary. There's less demand for the same amount of goods. So these are all things that are moving around the economy. What we saw yesterday was we saw a drawdown in GDP growth, but I was less concerned about that because of some of the underlying data that said consumer demand is still there. This is just less inventory build.
Yeah, and I agree with you because we got consumer spending data today as well, and it has continued to rise up. The shift is from, when the COVID ended or when most people got vaccinated, the focus was on goods, and now it's going back to services. So we are seeing services inflation pick up. That's where consumers are spending. So let's shift our focus now to mortgage rates. I'm sure everybody has seen the headline that a couple of weeks ago, mortgage rates, average mortgage rates increased to 5%. Some of our clients are asking, does it mean that we are going to enter into a housing crisis?
Well, housing crisis is a big that's a big word, a big
Mm-hmm,
call. And we don't see that.
mm-hmm,
And we mortgage rates are going up. When mortgage rates go up, just to, once again, the simplicity of you wanted to buy that $500,000 house before, and for that $500,000 house, you were prepared to pay the $2,000 of monthly mortgage, and suddenly that $2,000 monthly mortgage went to $2,400, whatever it is. It went up from where it was before, because mortgage rates went up to 5%. And that seems to, do you actually tick down where you buy the house? Yeah, I'm going to buy that $450,000 house instead. That's the usual impact. So house price appreciation comes down when mortgage rates go up. The other factors on the other side of that are still supporting house prices, though, are kind of threefold. One is mobility. We still see mobility happening where it's been a reasonably a short time frame that we've had COVID, job change, other things that are happening, and that supports more house price interest demand. One is that unemployment is the number one indicator usually for what house price appreciation looks like, and unemployment is really low. It's around 3.6%, which is below the long-term Fed expectation of around 4%. They keep shifting that lower, but with the ability to have confidence that you can walk across the street and get a job, that you're going to get paid your salary, you still feel confident that, you'll go ahead and buy that $500,000 house. Finally, something that is a long-term secular shift almost that we've seen is the supply of houses is really low. The supply of houses for sale is really low. If you just do a little Zillow around your neighborhood and pull up the app and see how many things for sale are for sale, like I often do, there's not much for sale, and much, much lower than usual. So we are at historically low rates. Low supply is back to supply and demand. Low supply, even with the same demand, means prices can, at a minimum, remain sustained. That won't persist forever. We will likely see an impact to housing prices. I expect they will come down probably this year some. I don't see a housing crisis. We don't have the same amount of consumer leverage to unwind like we saw in the global financial crisis in 2007. Um, that gives me more confidence that we can see housing prices drop without a resultant crisis. But yes, we likely will see some house price drop.
Yeah, and I think I totally agree with you. So if you think about a consumer's wallet, the mortgage rates are going up. Maybe I'll not buy the, as you mentioned, the more expensive house. And even if I have to, I'm always going to focus on shelter and food first, right? So those are the last things that I'm gonna cut off from my budget. At the same time, maybe I will not take that trip that I was planning to just because my principal payments are higher. But I agree with you that I don't think it's gonna cause a significant slowdown in the housing market. Um, so my last question, and I think that wraps up everything. So from what I'm hearing, economy is slowing down. No, it's not. We are not heading into any severe financial crisis at the same time, but more of a business cycle with the Fed raising rates. We'll see some slowdown in the economy. And Fed has a very difficult task to achieve. So keeping all those things in mind, how do you suggest one should position their portfolios?
I would take care in putting more risk in your portfolio until we understand that the Fed is at the end of its cycle. And we have some charts that we presented recently that show that is probably around mid 2023 to early 2023. That doesn't mean when the economy stops. That means when we have more transparency as to what the Fed is going to do in the future, uh, when they're going to stop hiking. Right now, we have less transparency on that. That means that we still remain concerned. We aren't sure of the economic impact. We expect this coming week that we're going to see more data from the Fed, more commentary from the Fed, which may be more important on how they're going to navigate this difference between inflation and the economy. Until we get that, it's hard to give a rosy forecast and say we see growth going up, which means for investors, it's a time to understand that there are opportunities in the economy. We don't want to miss out. We don't go down to you know full risk off unless we see a crisis. We don't see a crisis. We see better balance sheets. We see consumer savings levels strong. I can paint the case for why things can remain sustained. At the same time, we don't have the exuberance of we're going to see a strong boost in spending because I think people are thinking about how much they can spend, just as you talked about housing, on a very anecdotal, simplistic basis. You probably still want to buy that $500,000 house because you've got your mind set on it, but you might restrain your spending in discretionary goods. You might not buy the trampoline for the backyard or the fancy red car. So that brings off the risk just a little bit. We are also looking at, when you have growth come down a little bit, expected real economic growth, interest rates, the 10-year treasury is a proxy for that. It gives you an indication of what that is. It still serves as a buffer. This is hard to say when we put this out because they've done so poorly this year, historically poorly. At some point, they will still be attractive for investors to have decent income and to serve as a risk haven when equity markets swoon. Though we want to have appropriate but not overweight to fixed income. We want to have opportunities available to us in the equity markets, certainly in those companies where we feel like the sectors have good cash flow production. Energy is actually one of those right now. Yet we don't want to be over exuberant, so we're not overextending ourselves.
Thank you so much, Adrian. These are all the questions I had. And thank you, everybody, for joining us. Please feel free to reach out to your advisor if you have any questions. And we hope you have a wonderful rest of the day as well as a great weekend. Thank you. Bye bye.
Thank you.